right. Hey, everybody. Welcome to the webinar. I am James Rainwater. Jamie Lowe is also here. Jamie and I have worked together for a few years now. He's currently with Baker Wealth Strategies. Jamie and I started working together years ago, and I met him. He was actually part of the compliance team for my firm. So we go back a few years. He's great to work with and is with a great team over at Baker. Today, he's going to go through the cash balance plan and explain the nuances of it, how it can really benefit our clients when we're doing more advanced planning. And it's one of the few strategies that can really be used and pretty powerful after year end. So even right now for last year's tax returns, if they aren't filed yet, this is still kind of an option. We're getting close to the deadline that Jamie will explain, but it's still an option for some of that advanced planning for clients that we're really trying to impact last year for. So with that, I will turn it over to you, Jamie, and let you go through it.
Well, I appreciate the introduction, James, and you did a great job of highlighting some of the big advantages for the cash balance plan specifically. We'll talk a little bit more in detail about it and go through some of the high level knowledge that is important to know when you talk to a client or talk to a prospect about potential possibilities with some of those retirement savings and tax savings. So we'll dive right into it. I am with Baker Wealth Strategies. The agenda that we will have this morning, it looks a little bit like this. We're going to talk about what a cash balance plan is, how to include it in the tax plan. We've got some examples of some sample proposals. We talk a little bit about life insurance in this, and we use life insurance as an exit strategy. So we'll talk a little bit more about the tax benefit of that down the road, and then what the next steps would be to move forward. We will open this up for maybe some Q&A at the end if we have some questions, but always feel free to reach out. So a little bit about Jennifer Baker. Jennifer Baker is the CPA and CFP at Baker Wealth Strategies. She is our CEO and really the expert when it comes to partnering these tax strategies along with some of the investment strategies in the industry. This is obviously the required disclosures we have. This is all just for informational purposes. It's not intended as a solicitation. Feel free to screenshot this if you want to read it later. But otherwise, we will jump right into the biggest conversation piece around a cash balance plan is that it is a defined benefit plan, which operates a little bit different than a defined contribution plan. Defined contribution plan is similar to your 401ks. You're putting money in at a defined contribution on a regular period. At the end of that plan, whether the business ends or you retire or move on, you are owed whatever amount of money is in that account. With the growth or losses, whatever happens with those investments, you kind of know what your end dollar amount is. The cash balance plan as a defined benefit plan works backwards from that. You have a goal of what each participant is owed at the end of the plan. We usually design these plans in a 10-year period, but we can design them in different categories. If you have a business owner who knows they want to sell in a certain time period or is unsure of what they want to do over a 10-year period, we can design them differently. But traditionally, we look at them as a 10-year strategy. And at the end of those 10 years, we should know what each participant, each employee, and the owner are owed out of that account. That comes up with some more complications as far as the investment strategies and as far as how we make sure that those required credits are being hit. But that's the main difference between the 401k and what a cash balance plan can offer. Those two do not have to be run in opposite of each other. They actually can work really well in conjunction to provide a maximum benefit to an employer as well as their business. So what is a cash balance plan? It is a defined benefit plan. We talked a little bit about that, where it works backwards from a specified end balance. All the contributions are made by the employer. So unlike a 401k where an employee can contribute to the plan out of their own wages, everything that goes into the cash balance plan portion, the pension plan, is all done by the employer. This is what allows for very large tax savings in the business sector. It also makes sure that we can meet IRS requirements for minimum contribution across the company. Very similar to a SEP in that regard. Contribution amounts are determined by our actuaries, and a lot of that is based on age and wages. We'll look at some examples here in a little bit that highlight how age and wages can impact the amount that a business owner can put away. And this is specifically for clients who are looking to put away more than that $67,000 maximum contribution you could do into solo 401k, SEPs, things like that. We generally are looking at business owners who are wanting to put away probably more around $100,000 a year or more. Implementing the plan does come with some expenses and some costs. We have to pay for actuaries to run them. We have to file, we have to have a third-party administrator. So when you include the fees, we like to see that a little bit closer to the 100,000 plus. It just makes the plan make a lot more sense from a cost expense, but we can be very flexible on that. The investments are managed professionally. We do manage those ourselves. We can work with other people to manage them as well, but those investments are going to be handled in a way that aligns with the business owner's goals. We do want to make sure there's some protections and parts of the accounts that are set aside for those guaranteed credit raises that will go in for the employees. But otherwise, we manage the investments predominantly with the business owner in mind, because 95% or more, or around 90 to 95% of the assets are going to be the business owners themselves. A participant account does get credited each year with a pay credit. This is a standard set by the IRS, and an interest credit. That's why we want to make sure that portions of the investments that we are managing are managed appropriately with a nice moderate growth approach, not swinging for the fences for that specific bucket. We want to make sure that the business owner's risk is reduced as much as possible when it comes to these required and guaranteed credits. Also, the increases and decreases in the value of the investments doesn't necessarily affect the end amount owed to the participants. And this is coming back to the working backwards strategy and why we take so much care on the credit portion of the investments. The participant is going to be entitled to that benefit either way. And at retirement, or at the end of the 10 years, if we end the plan, that participant, the employee, is going to be able to either annuitize a portion of their money to get a guaranteed salary for life, or very similar to a 401k, they can also roll it over to an IRA, continue allowing it to grow, manage it, that kind of thing. So lots of flexibility with exiting the plan down the road. Here are some really key things to keep in mind, though, about cash balance plans. They're very scalable. When we work with business owners, our goal is always to demonstrate to them the absolute maximum that they can contribute to the plan. But every given year, these plans can be scaled up or down within the parameters, right? So for instance, a business owner might have a plan that they can either put in $20,000 as a minimum that year, up to $300,000 as a maximum. That's just an example, but that just kind of shows the way that we work with the business owners at the end of the year to figure out what makes the most sense for their business needs. How much do they have to put away? How much are they trying to save in taxes? All of those things can be looked at year in and year out. It's very important for the business owner to know that they are not locked into a super high contribution requirement every year. We can look at it year in and year out for the business needs. That's part of this flexibility. The plan can always be changed too. So if we need to lower funding beyond just the minimums, we can even look at rewriting the plan to kind of lower that $20,000 from the example even further if needed. But we always are targeting higher contributions. The biggest benefit to this is that at any given age, the 401k and profit sharing and SEP are never going to be able to get you as high as we can get with the cash balance plan. So again, this is really for those business owners that are looking to put away more than they could in, let's say, a solo 401k, while still maximizing very large tax savings for their business. There is a cost. Every employee will have a bit of a cost to them. We do have to meet IRS minimum participation requirements. So every employee will have a cost. But like I said, the plans that we almost always are providing to our business owners are plans in which the business owner themselves are keeping upwards of 90 to 95% of the total investment being put in. So while there is a cost to the employees, it's usually very minimal compared to the benefit that is going to be provided. Finally, we do always include our proposals with life insurance. There's a whole slide a little bit later that talks about why we include life insurance, and we'll go into that in a little more depth. But the highlights are, by using the insurance in it, we're giving them an exit strategy to move money from the taxable bucket down the road into their tax-free bucket by buying out a life insurance policy from the plan. And we'll talk about that a little bit more in detail, but it also allows for much higher limits to be put into the plan initially. Here are some examples of what a business owner at certain ages could be looking at putting away for a maximum. So if you have business owners in their 50s, you're usually looking at somewhere between $200,000 and $300,000 that they're able to put away into this pension plan, depending on their state, depending on their overall taxes. That's going to save them somewhere between $75,000 to $150,000 in taxes, right? So that's a big tax saving for a business owner, where they're able to essentially take money, put it away for themselves, and not have to put so much of it into the IRS's pocket. So a great strategy for your business owners to maximize their own retirement benefits and really reduce their federal tax obligations. Here's another example. Let's say an owner at age 59, they're paying themselves $300K with their spouse. They're each able to maximize some profit sharing. They're each able to put in a large amount into their pension. We include some life insurance there. Again, it allows this number to be even bigger, as well as creating an exit strategy down the road. This is a great example of, if you have a business owner and spouse, they're able to save a significant amount on their taxes and put away for their retirement. This is one of the few tools that they're going to be able to really maximize both of those options. This is just one more example where that business owner and spouse added 3 employees. You can see the contribution here. You're talking almost $600,000 for the business owners and only $12,000 for the employees. So again, while there is a cost that comes with it, most of the time the business owners are readily willing to pay that cost when they're talking about such large benefits for themselves. Here's another example of how this all would break down. Here we have the main business owner up here. They were 39, paying themselves about $100,000. They're putting away about $317,000 into their pension plan account. This is getting split up between the actual pension account. This is what will be used for all the investments. This will grow at however the business owner wants to invest this money. We will also include some life insurance for that exit strategy, as well as increasing the dollar amount. You can see for the employees, we're doing something very similar, but we've massively reduced the pension plan amount and moved a large portion of that bucket over into the profit sharing. And the reason that we do that is, again, to reduce the risk for the business owner. This dollar amount is that guaranteed dollar amount that the employee would be owed at the end of the plan, regardless of how any investments or anything like that performed. So by shifting as much money to this portion of the plan as we can, we still meet IRS requirements, but we reduce that business risk to the owner. Now, this investment is just going into an account that grows, and they are owed whatever is in that account at the end of the period. So it's a good way of shifting some of that risk. It still allows the business owner to maximize their investment options. Now, usually there's also going to be maybe some additional pre-funding or something along those lines. But even if we do just this simple plan, you can see here the business owner is still maximizing over 95% of the amount of investment assets. And if we assume a 50% federal and state income tax rate, they're able to save a little over $167,000 on their taxes for that year. So again, this is scalable. Let's say your business owner didn't have $300,000 they wanted to put in for themselves. Let's say it's more like $200,000. Okay, we would scale the plan down. That would reduce the cost for their employees. But this does a good job of showing how the plan works, the moving pieces involved, as well as how we can scale it up and down by changing the amount we're investing for the business owner and then reducing for the employees. James brought up a really good point in the introduction. This can work as a tax mulligan. It's one of the few products in the industry that you can go back and implement all the way up until you file your tax filings. So a plan, let's say you have an S Corp, you usually have your March 15th deadlines, your partnerships, your C Corps. But the nice thing about this is these can all be extended out to that September 15th deadline. And this is why James mentioned as well, we are on a bit of a tight deadline. We still have a few weeks if we have some, business owners out there who are trying to reduce their 2022 tax obligations. This is one of the few ways we could still implement that. It's going to take about 3 to 4 weeks to start the process, meet with the business owner, provide them a proposal from our actuaries, get the information from the actuaries into a plan design, get that over for account opening, and get funded. That all takes about 3 to 4 weeks. So we're pushing that September 15th deadline pretty tightly, but we still have some flexibility here to get a few plans done if anybody out there has a business owner they know could benefit from this in the next couple of weeks. I talked earlier about life insurance and why we include it. This is a little more in-depth conversation around the life insurance piece. First and foremost, the higher deductible contributions than investments only. So if we look back at our previous example, if we weren't including this life insurance, this $317,000 would probably be a little bit closer to the 280, maybe 290 range. Again, these are just estimates. These are all calculated by actuaries. But by adding the insurance, we're essentially able to increase the maximum that the business owner can put away for themselves. So it has that benefit up front. Secondarily, we're paying the premiums on the cash value life insurance policies with pre-tax deductible dollars. A lot of business owners love getting business dollars into a cash value life insurance policy for the availability to draw against that cash value down the road, either for business needs or retirement needs after they sell the business. This is one of the few ways, though, that we can actually use pre-tax dollars to fund that policy. By putting it in the plan, you're able to take those pre-tax deductible dollars and buy up this life insurance policy. However, at some point, we now need to remove that policy from the plan to turn those pre-tax dollars, or at least a good portion of them, into tax-free dollars. The tax-free retirement income and the death benefits that come off of the policies are purchased out of the pension plan, which is what allows for that exit strategy. So a great example of this would be, let's say a client puts in $50,000 a year into an insurance policy for the first 5 years of their plan. At the end of that, they have a policy that they've put $250,000 into. But if we design it with an exit strategy in mind, we design that policy to have none of the growth credits hit the policy before that 5-year period is up, effectively making that policy market value worth less than the cash value even within it. So that business owner in a future date after those 5 years is able to go take taxable dollars from elsewhere, their business, their personal funds actually, to take taxable dollars, put them into the plan and buy out that life insurance policy for the discounted market value rate. Once that policy has been bought out, you've now got the same amount in the retirement plan you had before, and you have a policy that is held outright that's going to provide tax-free benefits in retirement. So again, what we're looking at is trying to maximize the efficiency of the plan. We don't always want business owners to have a massive tax-deferred bucket when they hit retirement. That can create a lot of other complicated tax issues. So balancing the amount that they have in their taxable bucket, along with using the insurance, the life insurance codes for the tax-free bucket, provide us an added layer of efficiency to the plan that makes it even more valuable to the business owner long-term. Now, some of you might be thinking, I do have a business owner who could benefit from this. What would the next steps look like to get something going? We would love to meet with you either before or on the call with your business owner. We would just be gathering some business payroll information. We would then be sending that information off to our actuary team. They would be coming up with a custom tax strategy based on the needs for the business owner. Once that was done, the business owner would have a chance to look over the proposal, decide it's right for them, decide how much funding they would want to do, give us the approval. The actuaries then go out and get the plan installation paperwork. They go out and file for everything. We get the account set up for the investments. We go through the underwriting and funding policy, and then we take care of all annual plan administration with our actuary team. So the providing of reports out to employees at the end of the year, the filing for all tax required 5500s, IRS required forms, those things, those would all be taken care of by us and our team. So it's a very easy process. Like I said, from 1 to essentially the end of 3 is about a 3 to 4 week process. 4 and 5 can be done after the tax filing deadline. They're not nearly as important, but steps 1 through 3 would need to be done before taxes were filed. Again, let's just cover some of these highlights, some big key takeaways from the cash balance plan and why we think it's so important for tax professionals to be aware of. You obviously have those tax benefits now. All the contributions going into the plan are all tax deductible, as well as you get some tax credits for retirement plans that your business is funding. So a lot of tax benefits now, definitely some tax benefits later. When we are designing it with that life insurance, we're able to take about a 60% market value on that policy, which gives you a lot of growth in the tax-free bucket once that policy is bought out. So we're not only targeting those benefits now, but if taxes are higher in the future, we're also protecting our clients from those rising interest rate or rising tax rates by getting that money into a different bucket. We have the increased retirement savings. The cash balance plan is going to go a lot higher than your 401ks and profit sharing plans. And this key right here of that tax mulligan. There are very few ways to meet with a client after the end of the year, 12/31, and be able to do a whole lot to impact their taxes through investment strategies. This is one of the few ways that you're able to do it. You're able to go back and set this up all the way up until you do your corporate filing. So a lot of flexibility here. Business owners love it because they can wait until their fiscal year is over, meet with their tax team, decide what really makes the most sense, and then move forward with funding. They don't have to feel pressured to know that information before they have a full look at their tax needs. That's kind of the wrap on the cash balance plan. We are always happy to answer any questions. Both of our emails are listed here for me and Jennifer. I believe most of you know how to get in touch with James as well. Please feel free to reach out to us if you have any questions or if you think you might have a business owner that could benefit from this strategy. James, that was essentially all I had for the cash balance plan. I don't know if we have any participants who want to ask any questions or if we want to wrap it here and kind of leave this open for posting.
Yeah, if you guys have any questions, you can go ahead and throw them either in the Q&A or the chat. I know the chat doesn't always work well on the webinars. But if you guys have any questions, throw them in there. You can also shoot an email to Jamie or Jennifer. If you have follow-up questions, maybe you don't want to put them into the Q&A. We can give that a second. And then if there's no questions, we can wrap up. But Jamie, thank you for walking through that and presenting the cash balance plan. I know our clients have gotten a lot of value out of that, and the way you guys structure it is certainly unique and beneficial to our clients. So I appreciate
it. Thank you for that. We really enjoy it. We love working with the tax professionals to bring to life some of these strategies, right? We know that everyone out there is doing their best to bring the best tax plans they can to their clients, but at some point, the clients need help implementing those as well. So it's great to be able to add these cash balance plans to your tax plans to show these large tax savings. And at some point, if you need help implementing them, we are here to assist with that as well. So yeah, please feel free to reach out. I didn't see any questions come through. So maybe we can wrap it up here, James.
Great. Yeah, we'll go ahead and wrap it up. Thanks again. Everybody have a great day today.
Thanks for your time.